For merchandisers company, the same thing. Okay, so those journal entries on adjustments also applies to merchandisers company, but we have one more category of adjustments. Okay, so the prepaid expenses, the accrued expenses, depreciation, accrued revenues, and earned revenues, all of those also apply to merchandisers company. But we have one more on inventory. Okay, because again, this is the account that service type of business do not have, so only merchandisers have this account. So this entry tells us that at the end of the month, at the end of the quarter, or at the end of the year, typically at least at the end of the year, perpetual inventory, the company that uses perpetual inventory system also has to do a physical count of the inventory, the items, and the value at the end of the year to see if it matches with the inventory value that's there in their system. So remember, the feature of perpetual inventory system is that it continuously updates inventory level. Remember we talked about barcodes? Whenever cashier scans the barcode, that action immediately links to inventory account and cost of goods sold. But at the end of the year, a company still wants to make sure that the inventory value that they're disclosing to their user, the financial statement, actually is inexact and matches with what they have in their warehouse. So they will do a physical count at the end of the year to make sure the inventory value there matches with their system. But if not, in any cases, if the inventory in the warehouse has a lower level of value compared to what's there in the system, then the difference is here. We journalize this adjusting entry. Okay, so meaning this entry represents that the system, we have $40,500 of inventory, but when we do an actual count of the inventory in the warehouse, altogether only worth $40,200. So this difference is the $300. We bury it into cost of goods sold expense account. We're just assuming that this is a part of the inventory that cost of doing business, we accidentally either had an error in the middle when the cashier scanned the items, or possibly it could be stolen by employees or customer accidentally and we didn't caught it on time. Any cases, if there's a differences there at the end of the year when we do an actual physical count, match it with the system, the differences we capture it in this journal entry. So this entry actually looks exactly the same as the second entry whenever we make sales. And whenever there's sales transaction, the first entry is on retail price, the second entry looks exactly like this. Okay, but this case here, the $300 doesn't represent any sales. It represents the adjustments. So the two numbers differences, one is originally what's the inventory cost there in the system, one is after you do the count, what's actually there, what do we actually have. Okay, so the differences here, we're bringing down what's listed there in the information system under inventory account, reduced it so it matches with what's there in the store. Okay, so the differences here is what we call inventory shrinkage. We think of this as the cost of doing business. So in some cases, for example, if a customer has, let's say a grocery store, they have 30 items in their cart, and let's say by accident the cashier missed scan one of the items. So the customer took it back home. Unless the customer took it back to the store, there's really no way to identify whether that item is actually lost in the middle, it's on the ground, or at the customer's home. But it's definitely not in the store. Right? So if they accidentally missed to scan one of the items, that inventory account will not be updated by that item. It seems like the store still has the item on the shelf, when in reality it's elsewhere. Right? So that's one case, and if at the door they don't have any internal control system that will ring for some of the items that hasn't actually been scanned, then there's really no way to identify this type of error in the middle. Okay, or in other cases in the warehouse, they're just accidentally some of the things that rolled on the floor, and then the janitor came to just sweep it away. So that case is also some of the minor items in size. There's no way to identify these unless somebody realized this event actually took place and went back to look at the camera, so on and so forth. Okay, so this we think of it as the cost of just doing business. We vary the differences Usually these are minor differences. We vary it into inventory account by reducing it and then list it as cost of goods sold expense. All right, so this is one additional adjusting entry. Besides the ones that we introduced in Chapter 3, for inventory, there's another adjusting entries matching the actual inventory value with the system.